You've seen this 100 times on BTCUSD. The trend looks clean, the super trend flips, you enter, and then the very next candle whips back through the line and traps you. The painful part is that super trend is doing its job. It reacts fast, but the market doesn't always have real conviction behind that flip. Sometimes it's just a quick poke with weak participation, and those are the flips that usually fail. This indicator is built to fix that exact problem. SuperTrend plus Relative Volume Kernel Optimized takes a normal SuperTrend signal and then asks a better question. Is this break actually meaningful, or is it just noise? It answers that with a probability score called KDE%, based on how past SuperTrend breaks behaved and how strong the relative volume is during the break. To set it up, we're using TradingView, the platform I'm using for this video. If you haven't signed up yet and you want to follow along with the same setup, there's a link in the description. Open BTCUSD and switch to the 1-hour time frame. Click Indicators, search SuperTrend plus Relative Volume Kernel Optimized, and add it to your chart. Once it loads, you'll notice it still behaves like a super trend at the core, but with extra intelligence layered on top. You'll see the super trend line itself, and you'll see the trend state, bullish when price is above and bearish when price is below. In the latest updates, it also added trend coloring, plus settings that let you disable the super trend line entirely if you only want the signals and the probability layer. It also added a fill gradient option, and you can disable that too if you want a cleaner chart. Now let's talk about the thing that makes this indicator different, the KDE%. KDE% is basically a probability estimate. It represents the likelihood that the current candlestick is a true break of the super trend line and that the break is supported by a meaningful shift in volume. If the KDE% is low, the indicator is telling you this break doesn't look strong compared to what historically leads to real trend changes. If the KDE% is moderate to high, it's saying this looks more like the kind of break that usually matters. Start watching for confirmation because a reversal or a meaningful move is more likely. Here's how it works in plain English. First, the indicator calculates supertrend using ATR, just like a normal supertrend does. When price breaks above the supertrend line, that's logged as a bullish break event. When price breaks below, that's logged as a bearish break event. Second, it calculates relative volume for each break. Relative volume here means current volume compared to the average volume over a set period. The logic is simple. A break that happens with unusually strong volume is more likely to be real than a break that happens on weak participation. Third, it applies kernel density estimation, KDE, to those historical break events and their volume behavior. KDE is a way to estimate how likely something is, based on the distribution of past examples. The script builds an internal density array using your KDE options like bandwidth, steps or bins, and the range the algorithm scans. Then it uses a Gaussian kernel function to estimate the likelihood that the current break fits the same signature as meaningful breaks in the past. Finally, it turns that into the KDE% you see on the chart. Then it uses your threshold to decide how confident the signal is. If the KDE value is above your activation threshold, you get a stronger looking signal. If it's below, you still may get a signal, but it's shown as lower confidence, more transparent, so you don't treat it the same as a high probability break. The signal is also plotted after bar confirmation, so it's not jumping the gun mid-candle. One more important detail, the script updates made the KDE logic directional. Bullish KDE and bearish KDE are split, and they use buy and sell volume respectively. That matters because bullish conviction and bearish conviction don't always show up the same way, especially on crypto. Now let's go through the settings because this indicator is only as good as how you tune it for your market. In the SuperTrend settings, you have two core inputs. ATR length controls how the average true range is measured. A shorter ATR length reacts faster and flips more often. A longer ATR length reacts slower and gives you fewer flips. Multiplier controls how far the supertrend line sits from price. A smaller multiplier hugs price more closely, so you get earlier flips, but also more whipsaws. A larger multiplier sits farther away, so you get fewer flips, but they tend to be cleaner and more trend-focused. Then you have the KDE settings, and this is where you're basically tuning how strict the probability engine is. Bandwidth controls how smooth the KDE curve is. Lower bandwidth makes it more sensitive to the most recent and most specific patterns, which can be sharper but noisier. Higher bandwidth smooths things out, which can reduce noise but also reduce responsiveness. Number of bins or steps controls precision. More steps means finer detail in the KDE calculation. Fewer steps means the calculation is more coarse. Higher steps can feel more smart, but it may also be heavier and slower depending on your chart and device. KDE threshold percent is the line in the sand for signal confidence. If you set it lower, you'll get more high confidence signals, but the quality can drop because you're letting more marginal breaks pass as valid. If you set it higher, you'll get fewer high confidence signals, but the ones you do get tend to be the more extreme, more convincing breaks. Relative volume length is the look-back period used to compare current volume to average volume. A shorter length makes relative volume react faster to recent changes. A longer length smooths it and makes high relative volume harder to trigger. You also have display-related options that were added over time, like the ability to disable KDE percent text, disable the SuperTrend line, and disable the fill gradient. The point is, you can keep it clean if you only want the arrows in trend state, or you can keep the full visual layer if you want the probability feedback on every break. Now let's get into how to trade this the right way, without turning it into guesswork. The core rule is simple. You don't treat every super trend flip equal anymore. You treat it like a two-step process. Step 1 is the super trend break itself. Price crosses the super trend line and closes on the other side. Step 2 is the KDE percent and the signal strength. This is the "is it real" filter. So here's a clean long setup on BTCUSD 1 hour. You want price to be in a bearish phase, then you get a candle that breaks above the super trend line and closes above it. That's your first clue. Now look at the KDE percent on that breakout candle. If it's low, you don't chase. You treat it like a warning that this could be a fake flip. If it's moderate to high and the signal prints as the stronger, darker bullish arrow after confirmation, that's where you start paying attention because the break is showing historical, real break characteristics plus volume support. Your entry is not buy instantly. Your entry is after confirmation, ideally on the next candle or on a small pullback that respects the super trend line as support. If price breaks above and then immediately dumps back under the line, you skip it. If it breaks above with high KDE percent, holds below, and then prints follow through, that's your take. For risk, the clean stop is either under the super trend line or under the most recent swing low, depending on how tight you trade. Then you can target 1.5R or you can use structure, previous highs, range highs, or a key resistance zone on the chart. The whole point is you're not just trading green equals buy, you're trading green plus high probability plus volume-backed break. Now for shorts, same logic in reverse. Price is bullish, then it breaks below the super trend line and closes below it. Check the KDE percent. If it's low, you don't rush. If it's moderate to high and you get to stronger bearish arrow after confirmation, now you're looking at a break that is statistically more likely to hold. Enter after confirmation, ideally on the next candle or on a retest where the super trend line acts like resistance. If price breaks below and then instantly reclaims the line, skip it. If it breaks below with high KDE percent, holds below, and then prints follow through, that's your short. Stop above the super trend line or above the most recent swing high. Target 1.5R or the next clear support zone. Again, you're trading the break only when it looks like a real break, not a random flip. Here's how you should interpret signal strength so you don't get tricked. A transparent arrow is basically the indicator saying, yes, the super trend line broke, but the probability engine isn't impressed. That doesn't mean it can't work. It just means you shouldn't treat it as high confidence. In those cases, you either demand extra confirmation, like a retest hold, a strong follow-through candle, or alignment with higher time frame trend, or you simply pass. A darker arrow is the opposite. It means the KDE value cleared your activation threshold, so the break looks more like the kind of move that historically leads to meaningful continuation or reversal, supported by relative volume behavior. That's why this indicator is powerful. It doesn't remove risk, but it helps you stop giving equal weight to weak flips and strong flips. And because the script is open source, you can actually review the logic yourself if you want to verify what it's doing. No black box. This is not financial advice. Everything here is for education only. Test this indicator on your own charts, build a full plan around your own risk tolerance, and always double-check your idea before taking any trade. If you found value in this breakdown, hit the like button. And if you want more indicator guides like this, consider subscribing so you don't miss the next one. Thanks for watching. See you next time.